I think the hardest part of investing right now is understanding what assets to avoid. Historically low interest rates globally have led to asset price bubbles across most asset classes. We've seen bond markets rally to sort of new time highs, and at the same time, equity markets are at or above new time highs. The concern there is that the bond market and the equity markets are actually pointing in different directions. Bond markets at all-time highs is actually suggesting that there is an economic recession, or at least an economic downturn, about to occur within the economy. In the face of that and some weakening economic data, equity markets have still continued to rally. People often forget about the power of negative compounding. Compounding is a beautiful thing. However, it is actually more influential on the downside than it is on the upside. For example, if equity markets were to fall by 20% tomorrow, you would have to make 25% just to get back to square. Therefore, it's really important to avoid losses in your portfolio in achieving your overall goal and outcome over time. What does that mean for the way that we have portfolios positioned? Well, right now, we do think bond markets are expensive. So as a result, we have a preference for cash. In our real return balance portfolio, we're holding approximately 30% cash. That cash is sitting there on the sidelines waiting for a sell-off in market so that we can redeploy it at cheaper valuations. Within equity markets, we prefer markets where there are definitely pockets of relative valuation. So Europe, Japan, and even the UK, and that's taking into account a disorderly exit from the European Union. The areas that we find really expensive are the US and the Australian equity markets. Within the US, for example, the balanced portfolio only holds a 5% allocation to that market, which is very low. We typically like the more defensive sectors like healthcare and consumer staples, predominantly because even in a recession, people still have healthcare needs and they still need to eat. The other thing that's important to understand is that given markets are so overvalued at the moment and are likely to mean revert, our expectations for future returns over the coming years are quite low. Even in our favoured equity markets, we expect low single-digit returns. Now, for those markets, for equity capital markets, you should typically, in a normal market cycle, expect high single-digit to low double-digit returns. So the return profile is going to be lower going over these next sort of 5 to 10 years. It's important, therefore, that you understand that achieving objectives like CPI plus 3 or CPI plus 4 will actually be quite challenging going forward. Hence, the importance of avoiding losses and ensuring that the portfolio is conservatively positioned to achieve your ultimate goal and objective within your fund.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.